Hey guys, it's Chris Wong. I'm filming this video as of August 25th, 2025, and I'd like to talk about several purchases I made in the last week when the market dipped down a bit. So, as a disclaimer, I'm not a financial advisor, I'm just guys interested in building a portfolio. So, I made purchases in my Wealthsimple and my Questrade margin accounts, and when I was making purchases, I eventually was telling my wife that I started having a shopping problem for investments. So instead of having a shopping problem for purchasing goods and services at any other retail stores, I actually describe myself as having a shopping problem on the stock market because I see sales and I see potential to increase my dividend income. So in the last week, I saw that the Nasdaq went down a little bit harder than the S&P 500. So I actually decided to put more focus towards the Nasdaq than the S&P 500 base ETFs, and I also decided to pick up more MicroStrategy ETFs because MSTR went down in share price, and I decided to take a chance and add more shares of the Harvest MSTE, and I decided to add more of the American ones like MST by Defiance, MSII by Rexshares, and start picking up a position of MSTW by Roundhill. I also added the Coinbase ETFs like CNYE by Harvest ETFs, COYY by Granite Shares, and COII by Rexshares. So I'm just taking a chance on it. And the reason why I picked up from multiple ETF providers is because I wanted exposure to different ETF providers in case something happens or the dividends payout are different. Like once in a while, I'll see one ETF provider pays out a much higher dividend for that week than another ETF provider, and it's supposed to follow the same underlying. I also like to have different payout dates for different American ETFs. So for the weekly paying ones, I noticed that Granite Shares, I believe, pays on Tuesdays, and MST pays on Thursdays. And the big ones that I have, like Defiance, S&P 500, like WDTE, QQQY, IMWY, and also the Yield Max ones like YMAX, YMAG, generally pay on Fridays. So this time, while buying on margin and trying to learn from my last experience when the market crashed last April, and I got a massive margin call or multiple margin calls and had to transfer money and sell some funds at a loss, I decided to still buy on margin but have better precautions. So instead of trying to use a lot of margin, I'm using a little bit less. But I also try to calculate how much of my portfolio is still equity relative to assets, or I just calculate the other way around, like how much liabilities relative to the assets. So, for example, if the portfolio value, if the total assets is like $10,000, and I want to maintain at least 50% equity at all times, so that means the liabilities or the margin usage should not be higher than $5,000. And that includes like taking money out to spend or using margin to purchase other shares. So if I were to take the $10,000 of assets and minus $5,000 of liabilities, then that means $5,000 is left for the equity. And then if I take $5,000 of the equity and divide that by 10,000, so the equity portion is 50%. I use this approach from high school accounting, looking at a balance sheet to calculate how much of my portfolio is actually equity or how much is actually liabilities. And then I like to do like a quick calculation of what happens when the portfolio drops. So if the assets is $10,000 and the liabilities is 5,000, and what happens if the market crashes? So let's say it crashes by 50%, which I think it's very rare these days to have 50% crash. So that means instead of the total assets being $10,000, it would be $5,000. But then the liabilities is still $5,000. So that means the equity is zero, and I'm in a severe margin call. So to settle a margin call, that means I have to actually contribute money in order to maintain the equity, or I have to sell positions at a loss in order to try to get the equity portion back to its correct margin requirement. And depending on how lenient the brokerage is, or if the market could pick back up in time, the brokerage can give me 2 days to try to correct it, or they may give me only like 5 hours. So going back to other purchases I made, I actually purchased Hamilton ETF's QDAY, QDAY, which is a 0DTE cover call ETF based on technology. And some people describe it as it actually is similar to the NASDAQ 100. So I actually consider this as my NASDAQ exposure as well. It's like a 20% dividend yield approximately, and it pays every 2 weeks. So I actually like the idea of having ETFs try to pay back as often as possible. And for the Canadian ETFs, they don't have weekly paying yet, but they have a bi-weekly paying. So I did a calculation of how long it would take for the bi-weekly dividends to pay back the margin from the day I just purchased QDAY. And if I make the assumption that I don't purchase anymore, it seems like it would take me around 5 years for the dividends itself being paid every 2 weeks, assuming it's the same dividend every single 2 weeks, in order for the total dividends to add up to the original investment and to pay down the margin by that much. So another concern with purchasing ETFs, especially on the US market for Canadians, is if I'm purchasing, whether on margin or no margin, or in my TFSA, any US listed ETFs have withholding tax. And I noticed on my 2024 taxes, the dividend income from the US listed ETFs, they were still taxed a lot. And it seems like I was taxed more than the Canadian listed ETFs. But I actually like the idea of still having weekly paying ETFs, and I really do like the high yields. So I just look at it as trying to pay down my portfolio. If I'm taxed on it, then I don't use that money to spend yet, or I just learn to spend less than what my predicted after-tax income is. I started getting more Canadian ETFs on margin because Harvest released plenty of ETFs that had pretty high dividend yields. So TSLY, MSTE, CNYE, they're more than 20% dividend yields as of today. And with dividend yields that high, they can pay down the margin within less than 5 years. And I'm hoping with the MSTE dividend every month, and that's the assumption that the underlying does well for many years, that I will continuously get high dividends for the next 2 or 3 years for it to fully pay off the original investment. Even though I was purchasing a lot of the MicroStrategy ETFs in order to try to average down my current holdings and to try to increase my dividend income, I still have to watch out how much to purchase relative to the rest of my portfolio. Like, I still want to make my portfolio more focused on the indexes, like the S&P 500 and the NASDAQ 100, because those ones would handle crashes a lot better. The MicroStrategy ETF is just based on MicroStrategy, so all it can take is the company itself to go down and the investment go down a lot, or all it takes is the company to go to zero and then the MicroStrategy ETFs will go down to zero. So another thing I did in order to protect my account was I purchased shares of YQQQ and SPXU over time. And I did this when both the NASDAQ and the S&P 500 reached its new highs before this last dip. And I actually decided to purchase some more today when it looked like the market almost reached its new highs, or it just was higher than last week. So it seems like I want to keep a certain ratio between my regular ETFs that have a long-term trend to have a positive total return, and the inverse ETFs where the long-term trend is a negative return. So YQQQ and SPXU. So these inverse ETFs, I just decide to hold on to them no matter what happens in the market, unless there's like a huge crash like last April 2025. And at that time, it looked like it caused SPXU to go up by $10 a share for that one day. So that might be the only time I may consider selling the inverse ETFs for a profit. Otherwise, right now, I just look at it as it's just there to protect my account. In the long term, I don't care if I lose money on these inverse ETFs because I'm making most of my gains on my regular ETFs with the long-term trend going up, and the long-term trend of the inverse ETFs, I see them are supposed to do the opposite. So if I treat it as a buy and hold, they are going down, but I'm just buying them when the market is up because the share price of these inverse ETFs are down or trying to reach its new low. As time goes on in the long term, I'm going to get paid more dividends, and the long-term goal is to buy more ETFs related to the indexes so that I can try to increase my monthly or weekly dividends. If the market is down, I put more focus on the regular ETFs. So like last week, I put more focus to the ones with the long-term trend to go up. So that's why I put more focus on MSTE or the other MicroStrategy ETFs, and I put more focus on the NASDAQ ones. So like QDAY, TQQY by Granite Shares, and I even considered buying QQQY by Defiance. So at that time, I did purchase a few more shares of SPXU and YQQQ because I was still averaging down my share prices, and I didn't know if the market was going to go down further or it was going to pick back up. It's very hard to predict those things. So another thing I did was I withdrew some cash out of my margin account and transferred it to my wife. And I remember explaining to her that I want to make sure my buying power is less in my account and that there's extra cash that I cannot have access to in order to prevent me from using too much buying power. And the money is just sitting in her bank account, not to be invested. So in the event I make a mistake and I need to sell margin call, then that could be an option. Or if there's a big market crash and I'm not in margin call, then that's money that could be used to take advantage of opportunities. I hope you guys liked the video. If you liked the video, please give me a thumbs up. Otherwise, please subscribe to my channel for future videos. Thank you guys for watching.